Are you feeling confused, concerned, worried, even powerless about your retirement accounts and the serious cash that you set aside for your future? You're not alone. Many people have felt the same way, especially during the last 6 or 7 years, where in this volatile market, we've seen some people lose as much as 30% on their retirement accounts. How do you protect yourself against those types of uncertainties? How do you create stability? Will Rogers once said, people are more concerned about the return of their money than the return on their money. And I know many people wish they had the account value they had just a few years ago. I've been a financial strategist and retirement specialist for 34 years, and the best vehicle and strategy that we have found is an indexed universal life, where you maximum fund an insurance contract and the return that the insurance company credits is linked to an index such as the S&P 500, the Dow Jones, or the Euro Stock Index. When that market loses, you don't lose because your money's actually not invested in the market. So you get a 1 or a 2 or 3% guaranteed return. If the market were to have a great year, you get to participate 100% up to a cap of maybe 12 or 15%. Now, I'm not a gambler, but if I were to go to Las Vegas and some casino told me I could play there all day and they'd cover my bets, and if I lost money, at the end of the day I would still walk out with 1 or 2% more than I walked in with, but whatever I made, I could keep 100% of it up to a cap of 12 or 15%. I think I might play in that casino. Well, that's what an indexed universal life can do for you. It takes out that uncertainty and protects you when the market goes down and lets you participate indirectly, because your money's not actually in the market, but the insurance company is crediting you whatever the index does. Let me give you an example. The last 8 years, from 2000 to 2007, if you would have invested $100,000 in the market in the S&P, for example, during those volatile years, you would have lost as much as 14 and 17% consecutive years in 2001 and 2002. At the end of 2007, your account, even though it rebounded, would only be worth $111,000 or 1.54% average annual return. With this strategy of indexing, you would have received a 1% guaranteed return in a down market and up to a 15% gain in an up market, and that was the cap. Instead of $111,000 being in the market, if you were using this indexing strategy, your account value would be $164,846. That's $53,500 more in just 8 short years, or a 7.4% average annual return when most people were losing money. Since 1950, if you would have had this strategy, you would have ended up, instead of with $8 million, starting with $100,000 being in the market, you would have $11 million. That's $3 million more cash using the indexing strategy rather than being at risk in the market.